Welcome to this explainer. If you're following the markets, you're probably used to staring at ticking stock prices all day long. But have you ever stopped to wonder how exactly that specific number is determined? Well, today we are diving straight into the chaotic mechanics and the underlying math to find out. Seriously, why is that stock price constantly changing? If you've ever watched a ticker flicker up and down, you might picture a bunch of Wall Street suits sitting around setting prices in some smoky backroom. But the reality? It's actually much more fascinating, and honestly, a whole lot more chaotic. To demystify all this, we're going to break this explainer down into 4 quick parts. First, the battle behind the price. Second, what intrinsic value actually is. Third, how to calculate true value. And finally, value investing versus market hype. All right, part 1, the battle behind the price.
So the heart of the stock market isn't some giant calculator quietly crunching numbers. It's actually a massive, real-time haggling match, and it's known as the order book. Picture this. You have bids from buyers shouting out exactly what they're willing to pay, clashing right up against asks from sellers who are holding their ground on the absolute minimum they'll accept. That current price you're looking at, it's really just the exact second a buyer and seller finally blink and meet in the middle.
And this creates a wild dynamic. When buyers get hyped up, man, it sparks a bidding war. They start throwing out higher and higher bids, basically begging sellers to hand over their shares, which drives the price straight up. But on the flip side, when bad news hits, total panic. Scared sellers will just slash their prices to offload shares as fast as possible to literally any willing buyer, causing the stock to absolutely plummet. So the really crucial takeaway here is that the number you see when you open your brokerage app, it's usually just a snapshot of the last agreed deal. It's history, right? The real-time actionable price is actively battling it out in the order book right at this exact millisecond. Which brings us to part 2. What is intrinsic value? Okay, so we know the mechanics of how prices fluctuate day to day, but what decides if a stock should be changing hands at $5 or $500 in the first place? Well, that is where intrinsic value comes in. Think of it as the theoretical anchor for a stock's price. It strips away all that market hype and panic to look purely at the fundamentals. We're talking actual earnings, real assets, and realistic growth potential. But, and this is a massive catch, estimating intrinsic value is completely subjective. It's not like weighing a bag of apples today to see how heavy it is. It's more like guessing how much those same apples are going to sell for next year. It's a forecast. And that's exactly why highly intelligent investors can look at the exact same company and calculate wildly different numbers. So how do we actually figure this out? Part 3, how to calculate true value. The most prominent method investors use is the discounted cash flow model, or DCF. Let's strip away all the Wall Street jargon. DCF basically asks you to do 3 things. First, estimate the future cash profits the company is going to generate over the next few years. Second, discount that money back to today's dollars because, inflation eats away at future value. And finally, add in the terminal value, which is essentially your best guess of what the entire company will be worth at the very end of your forecast. Let's put some quick numbers to this. Say a company generates $100 a year for 3 years, and you discount that plus a discounted terminal value of, let's say, $1,000. Your total present value might be right around $1,000. Now, if that company has 100 shares outstanding, your intrinsic value is exactly $10 per share. What does that mean for you? Well, if you look at the order book and it's trading at $8, boom, you just found yourself an undervalued stock. But if it's trading at $12, yeah, it might be time to hold off. Now, because no single method is perfect, smart investors actually use a mix of strategies from a sort of valuation toolkit, depending entirely on the type of company. For instance, the dividend discount model is fantastic for utility companies that pay out reliable dividends. Then you've got asset-based valuation, where you just subtract debts from physical assets, which is perfect for real estate firms or banks. And for quick industry comparisons, you'd use earnings multiples, like the PE ratio. That's how you know, for example, that tech typically trades at around 20 times earnings. Moving on to our final section, part 4, value investing versus market hype. So what exactly happens when the perfect, cold math of intrinsic value slams right into the messy reality of human emotion? Well, value investors, they try to ignore the chaos. They use the math we just talked about to hunt for long-term discounts. Warren Buffett actually hit the nail on the head with this. He famously said that investing is like buying a farm. You look at its soil and its crops. You don't obsess over the fluctuating bids and asks of your neighbor. However, not everybody is buying the farm for today's soil. While value investors want those stable, predictable earners, think your Coca-Colas or your Walmarts, growth investors are playing a completely different game. They will happily pay massive premiums for a stock like Tesla, practically ignoring today's calculated intrinsic value because they are betting entirely on explosive, game-changing future expectations. And honestly, this is exactly why the market so often just totally ignores the math. I mean, intrinsic value can feel pretty useless for a biotech startup that has literally zero profits today but might cure a major disease tomorrow. Plus, you have external factors. Remember the drastically low interest rates from 2020 to 2022? That pushed investors out of bonds and straight into stocks, artificially driving prices sky high. Market sentiment and sheer hype can absolutely overwhelm fundamentals. As the old saying goes, the market can stay irrational far longer than you might expect. Ultimately, intrinsic value is a fantastic baseline reality check. But the live order book? That is a chaotic cocktail of math, future hopes, and raw human psychology. Knowing how to read both is what actually gives you an edge. So take a hard look at your own portfolio right now. In a market driven by both fundamental math and sheer hype, which one are you buying?